On September 25, 2025, Starbucks told its employees that 900 of them would lose their jobs the next morning. In the same filing, the company said it would close hundreds of cafes across North America and take a $1 billion restructuring charge. The stock barely moved. Wall Street had already expected the news. But that's not the big story, because the detail worth paying attention to is what the money is being spent on. The closures and the severance are the visible part of the largest operational overhaul the company has attempted in years, and the early numbers suggest it's working. This is the story of how Starbucks drifted away from the thing that made it Starbucks, and how a new chief executive is trying to rebuild it from the store floor up. In 1983, Howard Schultz was a young director of retail at a small Seattle coffee importer. He flew to Milan on a buying trip. What he noticed there were the espresso bars. People stood at the counter, they knew the barista, they lingered. The shop was somewhere between home and work. Schultz called that somewhere the third place. And he spent the next 40 years trying to build it at scale. By the time he first stepped away from the chief executive role in 2000, Starbucks had become a global brand. Then the company grew. It entered China in 1999. By 2015, China was the company's second largest market, trailing only the United States. It crossed 30,000 stores, then 40,000. It made mobile ordering mainstream. For most of that growth period, the third-place idea and the operating machinery of the company ran side by side. Schultz came back from 2008 to 2017, and then again as interim leader from 2022 to 2023. Each return was framed as a rescue. Each return was also a signal that the board could not find a permanent successor who understood what Schultz had seen in that Milan bar. Each stint ended with a handoff the board hoped would last. None of them did. When Schultz finally left, he still owned a low single-digit share of the company that gave him a voice that a resignation letter could not silence. That voice would matter again in 2024. Over roughly a decade, day-to-day ownership of the customer experience was handed to an algorithm. Mobile order and pay launched in 2014, and by the early 2020s, it handled nearly a third of US transactions. Baristas stopped brewing coffee for people standing in front of them. They spent their shifts working through a queue of phones. The condiment bars, giant ceramic mugs, and many of the armchairs came out. The space got louder while the orders got more complicated. The physical store stopped matching what the brand promised. By Q4 of fiscal 2024, the operating data showed it. Global comparable sales fell 7%, while US traffic fell 10%. China's comparable sales fell 14%. Same-store sales across the international business fell for 6 quarters in a row before the trend broke. In North America, it was 7 quarters. That is a long stretch for a company that spent most of its public history growing steadily. Howard Schultz, by then retired from the board, wrote an open letter on LinkedIn in May 2024. He called what was happening a fall from grace. He blamed US operations directly. He said the answer lay in the stores, not in the data. A founder who had already stepped back twice and said he would not return was now telling the current management team in public that it had lost the plot. China followed the same pattern. What had been the company's second largest market turned into its toughest operating environment. Luckin Coffee, a local chain that went through an accounting scandal and survived, overtook Starbucks on store count and undercut it on price. On November 3, 2025, Starbucks announced it would sell a 60% controlling stake in its China retail business to Boyu Capital, a private equity firm. The deal valued the combined China operation at about $13 billion. Starbucks would keep 40% and would continue to license its brand to the new joint venture. The structure brought in a local partner with the on-the-ground knowledge to compete with Luckin. It also freed up the company's own management time for the North American turnaround, which was the bigger operational problem. By the summer of 2024, the board had run out of patience. Laxman Narasimhan, who had been chosen personally by Schultz and who had held the chief executive job for about 17 months, was removed. The company's market value had dropped about $32 billion. Elliott Investment Management had quietly built a reported $2 billion stake and was pushing for board changes. The candidate the board chose was Brian Niccol, then the chief executive of Chipotle. Niccol had overseen an 800% rise in Chipotle's share price and nearly a 7-fold increase in profits during his 6 years running the company. He'd done it by fixing operations, focusing on areas like throughput, training, and menu. Discipline, the things that matter to a busy restaurant. The same problems Starbucks cafes had. The offer letter Starbucks filed with the Securities and Exchange Commission on August 14, 2024 is worth reading. Niccol's base salary was set at $1.6 million a year. His annual cash bonus target was 225% of base salary with a maximum of 450%. His signing bonus was $10 million in cash. His replacement equity grant meant to cover the Chipotle compensation he was giving up had a target value of $75 million. Starting in fiscal 2025, his annual equity target would be another $23 million. The first-year package was worth about $113 million. The offer letter also said he didn't need to move to Seattle. Starbucks would build him a small remote office in Newport Beach, California, and pay up to $250,000 a year in personal travel on the corporate jet. The news broke on August 13, 2024. Starbucks shares climbed about 20% that afternoon, the stock's best single day since the 1992 initial public offering. The market was reacting to the arrival of an operator whose last job had been to fix a restaurant chain of the kind Starbucks needed to become again. Niccol started on September 9, 2024, but spent the weeks before walking into Starbucks cafes several times a day trying to understand what the brand felt like from the customer side. What he found, in his own words, in a June 2025 memo to employees was that performance isn't yet where he wants it to be, and the company needed to move faster. The plan Niccol rolled out is called Back to Starbucks. At its core, it is an operational turnaround. The premise is straightforward. The financial numbers had drifted because the store experience had drifted. Fix the store experience and the rest follows. So that's where the money went. Condiment bars and giant ceramic mugs came back. Baristas began writing Sharpie messages on cups again. The menu was cut back so that every drink could be made faster and more consistently. Labor hours in stores were also increased. The company described it as its largest ever operating investment, with more than $500 million committed to store labor in the first year. That investment by itself reverses nearly a decade of the opposite trajectory. For years, the operating model had pushed labor out of the store and pushed orders into an app. Niccol put the labor back in. A 4-minute drink, a handwritten cup, and a barista who recognizes a regular customer. It makes them feel like part of the furniture all need the sort of human time that an algorithm can't replace. The company set an internal goal of serving most drinks in 4 minutes. At the time of Niccol's arrival, that was being met only half of the time. The sofas came back too. Remodels were planned for more than 1,000 locations where the physical space was rebuilt around seating, lighting, and a calmer atmosphere. The earlier design had prioritized throughput. The new design prioritizes the customer. Even mobile ordering was re-engineered using this new philosophy. The store is being given the ability to pace the app by sequencing drinks so the barista at the counter isn't overrun by a screen in the back. The menu has also been fixed. A tighter core menu means faster training, fewer errors, and a more consistent experience across 40,000 locations. It also frees baristas to spend time on the parts of the job that make Starbucks feel like Starbucks. On September 25, 2025, the company formalized the cost of all this with a $1 billion restructuring plan. It closed underperforming cafes, eliminated about 900 non-retail roles, and took a charge split between about $850 million of store-related costs and $150 million of severance. The store closures matter because of what they say about the rest of the network. The company is pruning locations that were never going to deliver the third-place experience and concentrating investment in the cafes that can. There have also been non-retail cuts that have flattened the corporate layer above the stores, creating a lighter head office and a heavier store-level footprint, consistent with the Move Faster message in the June memo. By Q4 of fiscal 2025, the operating picture had started to turn. Global comparable sales grew 1%, the first positive quarter in 7. China was up 2%. North America was roughly flat after 7 straight quarters of decline. The store served drinks faster and customers stayed longer. Those giant ceramic mugs reappeared in customer photos on social media. People began to notice. These are early numbers. 1 positive quarter after 7 negative ones does not settle the question. After a decade of drift, the direction of travel on the metrics that management can actually control, traffic, ticket size, speed, and consistency, has turned, and earnings were the last thing to follow. Full-year earnings per share fell to $163, down 51% from the prior year. The fourth quarter compressed to just 12. That's what a self-funded operational turnaround looks like on the income statement in year 1. More labor in the stores, more remodels, and a $1 billion restructuring charge are investments that hit earnings now. The payoff is expected in traffic, ticket, and loyalty over the next 7 years. The company chose to absorb that near-term pressure on earnings and get the rebuild done quickly. Starbucks today is being run by operators for the store. The brand is strong and the operating cash flow is real. The China deal brings in a local partner with the reach and speed to compete where Luckin has been winning. The question for the company is whether this management team can keep doing this long enough for the investments to turn into real financial results. The founder who built the brand has publicly told the current management that the stores are the problem. The current management has agreed and is spending real cash to fix them. The rise of Starbucks was built on a promise of connection, a place to sit, and a barista who knew your name. The last decade was the story of what happened when that promise was run through an efficiency pipeline that treated every empty seat as a productivity gain. Howard Schultz saw an espresso bar in Milan in 1983 and understood that it was selling something beyond coffee. 42 years later, the people now running Starbucks are trying to put that something back into the stores. One remodel, one hired barista, and one condiment bar at a time. Early evidence is that it might just be working.